Hey everyone, it is Evan here from the Trade Risk on Friday, January 4th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and then finish off looking at some sector analysis. So the first week is in the books of 2019. Happy New Year. Bulls off to a positive start for the new year. We did get most of those gains coming in late in the week on Friday. If we take a look here at the performance of some of the major indices here, you can see we had a monster session today, over 3% right across the board in all of the major averages. That does not happen often, and you can see the 5-day change now all in green territory. We have reclaimed the 10-period SMA, which is the shortest moving average we have here, which we haven't been above in quite a while, and we are above that, above the 10 SMA and all of the averages now, and we're above last week's highs. So some encouraging short-term technical developments here in the U.S. markets to start off the new year. If we look down here at sector performance, you can see you get some nice risk assets up here. We got biotech, which is leading the charge up here, with energy, which was really pulverized into the end of last year, and you can follow right down this list. Oil getting a nice bounce back, and some commodities and emerging markets holding up here in the top major market relative strength list. So let's jump into the charts here with the S&P 500. This is the weekly chart. You can see we're up 1.75% in the first week of trading for 2019. Remember, when you're looking at volume, we did still have a holiday shortened week. We were closed on Tuesday for New Year's. So do keep that in mind when you're looking at volume and when you're looking at just the general activity this week. It was a holiday shortened week, but nevertheless, bulls did make an advance to the upside here. There was a decent tail on the bottom end here, so we did try and probe lower into last week's range, but we did close the week off right near the highs of the week's trading, and we did close above last week's highs. That is encouraging, all things considered. MACD finally starting to stabilize and go sideways here on the weekly time frame that has basically been in a decline for the past 2 or so months. That's starting to flatten out just a little bit, and when we look here at some of the levels, we are right back to kind of kissing the lows of the year made back in February of 2018. So remember the beginning of the year when we had that brutal 2-week sell-off here, we made a low all the way down around 25.32. We touched it today on Friday, closed right below it. So we're starting to get back to some relevant levels from last year's range, last year's trading. There's still plenty of work to do for the bulls here. So as encouraging as this action is in the short term, there is still a mound of technical damage that the markets have to contend with. For instance, if we were to just throw some simple fibs on this chart here and we were to look at the latest drop, so just essentially starting in December around 2,800 where we topped out, down to the low we made last week, you can see that we've currently retraced approximately 38.2% of that downward, push to the downside, this latest leg lower. So really, we're still in, a minor sort of bounce here, and the 50% bounce would take us up around 25.76, and for you sort of golden ratio traders looking for that 61.8, it's all the way up at 26.30. So there's plenty of, room, I suppose, to continue this bounce higher. However, we still should understand the context in which we were bouncing, and it is still in this downtrend with lots of overhead supply. So that's the weekly look there of the S&P 500. Let's go down to the daily charts. Go to the S&P or the SPY ETF now, and you can see, the sellers had a couple of chances this week to break us down. The first was right here on Wednesday's open. So notice where the market opened here on Wednesday. It was a gap down below the prior 2 days lows, and this was a place where if this downtrend was going to persist and roll right over, you would have expected us to see basically this downward, this 1% or 1.5% gap down that we saw. Maybe a quick attempt to fill, but then just an immediate rollover there. Given the fact that we just opened at these prior days lows, tried to just do a swift kind of undercut and rollover in the most bearish scenario videos, that's what you would have seen, but we got the exact opposite. We got this nice, strong close right back up in this range. Now we had the Apple, we'll call it the Apple, the Apple guidance announcement on the afternoon of Wednesday that kept, that sent futures tumbling along with probably a handful of other things, but, one of the largest companies in the world down, lowering their guidance, tariffs, all that good stuff, gives the market some nice jitters to worry about. And of course, there are some real concerns of profitability being lowered there. But we had, again, this down open. This time up here where we started the session, and then we proceeded to sell off. We had this real ugly close here on Thursday. That was the sellers' kind of second chance to really hold us down. The bulls recovered the action here on Wednesday. Sellers were back at it throughout the session on Thursday. This was looking like pretty bleak, looking like we could roll over and start to retest these lows, and suddenly the market found that magical bid. You can call it Powell, you can call it some of the overseas news, but regardless, the market, quickly popped back up and basically, opened up near the lows of the session, drove higher all day, did not fill this gap, and here we are closing the week at new highs. So a couple of subtle clues there in the very short term that the market was acting fairly resilient. Two chances where the sellers should have taken the rollover. They couldn't get it done. So for now, this market is at least holding sideways, but looking like it wants to continue higher here. The levels I would pay attention to now is essentially this low here from Thursday. This is our good reference point to use. It's around 244. You could also use around this 246, 248 area. There's a couple of smaller levels in there if you were to look at an intraday chart. But you have a few levels to work with now going forward. Frankly, Friday's lows around this 247.50 or so, or 247 the figure. That would be a decent level. And then the lows here from Thursday to trade against, to measure risk against, to measure sort of the stability of the market. Those are a couple of the levels I'd be looking at. And then, of course, you have way down here the ultimate low that we made back on Wednesday, the around 233.76. We'll see if that does get tested or not. For now, the market seems like it wants nothing to do with it. On the upside, 253, again, that was the February lows. And if we can start to ratchet through here, if we can start to clear through this little mini consolidation we saw this week and continue higher, it seems likely, 260 would be the next target, would be the next destination for this market to retest. Remember, that was that post-Fed day right in here. Those highs right around 259.30 or so were the highs, which, were the kind of head fake highs, which started the real acceleration of selling lower. That was back on the 19th of December. So it'll be interesting to see if we can stay above and hold above this recent range here, hold above Friday's lows, to see if we can get back up into those upper to mid 260s. Again, keep the overall context in mind. When we looked here at the weekly chart, we're still in the midst of a downtrend here. We still have plenty of overhead supply, but we do have a recovery here from deeply oversold conditions. We have earnings announcements coming up soon. Earnings season will be kicking off in just a couple of weeks, so the market may want to get ahead of maybe some of the potentially positive or at least not so horrible announcements that some of the companies will be reporting. We'll see how that fares, but for now, getting that two-way trading, getting a bounce, buyers in control in the short term. If you're involved, if you're active, just keep those trailing stops in place, understand your risk, and we'll see what this market can give us for the second and first full week of trading for 2019. If we look here at the VIX, that really did come off this week as well. Go to the VIX here spot, came down to 21, so very quickly. Remember, we got as high as 36. So we had, if we look here on the weekly chart, a 25% decline in the VIX, almost down to the 20 handle here. You can see that is encouraging to see that there's a little more complacency out there. The fear has seemed to have subsided in the short term or intermediate term. Now, contrarians will say that is incorrectly. That is the incorrect move. That is the reason why we'll eventually be able to roll over. We'll see if that happens, but interesting to see the nice pullout and deflation there in the VIX. So let's go to some some of the other major averages here. We'll go to the IWM next, which was showing some relative strength here and continued to show some good relative strength into the end of the week. Remember, the IWM was the first. This is the small caps. This is the Russell 2000 ETF that tracks the Russell 2000. And this has been the sort of the leader here. It led to the downside back in really, September, October timeframe, and then back in even in December. And this latest leg, it started to really accelerate lower, break through some of the more critical longer term levels of support, and in fact got all the way back to retesting 2014, 2015 levels at the lows here. So the IWM has been leading in both the down and really the upside for this market, it seems, for the past many months. And we look here at the IWM, it is now starting to lead to the upside. Notice here on Thursday, for instance, this never really broke down below this range. We had a very clean range here with support around 131.65, 131.75 area. If you look at the SPY, for instance, remember we just looked at that. You saw the big kind of undercut here, the break below all of this previous levels. We look at the IWM, it held in there, printed an inside session, and then launched higher, very clearly above the recent highs here over the past 4 trading days. So the Russell seems to be leading here to the upside, putting in some good volume on these moves higher. Again, it was the most beat up, the most oversold, the most extreme to the downside. So this does make a little bit of sense as the unwind works its way higher. There is plenty of room here for the Russell to continue. In fact, all the way up to about 147 or so. That's the big, well, really 145 is where we're going to start to run into some of that overhead supply. But 145 to 147, there's plenty of room there, and that is room for, another 5 or 6% in the Russell. Not saying it has to go there, but that is the next logical place we would look at for some of that overhead supply. If we look at the NASDAQ 100, you can see here closing pretty much at the highs of the week, a little more cluttered in here. Remember, this didn't break down just as much. This is one of the relative strength of the major averages for 2018. This didn't get crushed as much. It ended just slightly negative on the year. And this was, or actually the Qs might have been positive. The composite, NASDAQ composite was slightly negative on the year. But the Qs here trying to get back to these December levels here, 160. That's going to be an important area to pay attention to. There's a lot of overhead supply in here back from November, December. If this continues higher next week, we'll look for that to be some type of retest and, actionable inflection point. So that is, the gist of the markets there, getting a nice bounce back. Short term, there seems to be some room to the upside here. We'll see if the bulls can stick with it. If we start to roll over, that's the time where we want to be very cautious in our exposure to the long side if we start taking out, say, prior day's lows, for instance. So let's get into some of the other major markets now. We'll go to TLT, which did finish higher here on the week, well off of the high. I shouldn't say well off of the highs, but reasonably off of the highs of the week. We had a very strong session on Thursday for TLT as maybe a little bit of fear really crept in there. And notice where this is occurring. This is occurring right at a prior sort of inflection point for TLT. This has been resistance for most of 2018. It ran right into it, and then notice the gap down here on Friday. So I think aggressive short entries using essentially yesterday's highs, Thursday's highs, stops above 124. Again, it's not trading advice, not a trading setup per se, but just looking at sort of resistance in here to continue to take hold. That makes sense. It's still a steep uptrend. You're still fighting that, but if you're a mean reversion type of trader, if you're looking for a little pullback here, retracement, that is an interesting setup there. No position in it myself, but we'll see if that can stick. Good volume had come in on this move. So again, it's counter trend, it's aggressive, but this is a longer term level to potentially shoot against. That was TLT. USO next. USO here on the week was up almost 7%, taking out last week's highs. Again, 7% doesn't mean a whole lot when you fall in 30-40% in just a couple of months, so there's plenty of technical damage still here. This one, USO, looking at it, does seem like it has some room back up to this recent consolidation here. Notice on this latest leg down in price action, we saw positive momentum divergence here, so a little bit of disagreement between the MACD and what price is telling us. gas. Perhaps if the bulls can continue in this move, we can get back up to about $11 or so. We'll see if that happens. Still a very damaged longer term chart. Speaking of damage, natural gas here still looks pretty rough. It did try to stabilize here into the end of the week. It's back to levels and areas that we were trading at back in July, August, September. It completely gave back this epic squeeze, this epic run up from November, where it popped about 55% in basically a month's time. It's unwound all of that, came right back to retest the scene of the crime, and now we'll see if we can get some type of bounce here. But quite a volatile instrument, natural gas is. Volume wasn't heavy on this downdraft here, which was always interesting, but again, that's just the underlying ETF that we're looking at for volume. So natural gas, we'll see if it can bounce. A little bit of structure here in the past couple of days, maybe a move back up into that $27, $28 area. Next up, if we look at metals, we'll get GLD here, which was getting a little bit frothy into the midpoint of this week. We had this little channel here. It doesn't seem like market really wants to care about it. So you could say it's under, kind of retesting the upper end of this now. But really, we saw this very swift rotation in GLD, very similar to TLT. Some will call it a safe haven asset, in terms of crisis. There could be some other, factors at play here. You can look at the dollar as that has come off a little bit here, taking off some pressure off commodities. And GLD, just generally speaking, though, had been in this nice uptrend, MACD making new highs. It's a little bit stretched here in the short term, so a little bit of pullback here wouldn't be too surprising. It was down 0.81% on Friday here, still up on the week overall. So GLD, we'll see if that can pull back just a little bit. Bulls do seem to be, very much in control there on the short to intermediate term. And silver got that breakout above $14. Good volume coming in here, and this one also is pretty stretched here in the short term. Didn't give as much back on Friday, but still a little bit stretched. Real tough to chase. It's tough to want to short this either, just given the fact it's resolved out of this multi-month range. So for me, I wouldn't be interested in really shorting either of these, GLD or silver, but a little bit of a pullback here would not be surprising. Be more interested in buying dips rather than trying to short this rip at this point. So that, I think, covers everything I wanted to. Let's get into some of the individual sectors this week. We look at the top 3 and bottom 3 performing. We look at IBB, and we are back to really the scene of the crime here, this $100 level. This was the breakdown. This is where we tested many times over 2017 and 2018. It was holding as support all throughout until the end of December, the second half of December. We came cratering through that $100 level. We kind of V-shaped our way down. We're V-shaping our way to the upside here, and we are trying to reclaim this 100 level. We look here at a weekly chart. This could be just a very epic kind of washout in hindsight. We'll see if we can actually hold on to this 101, 100 area going forward for a couple of daily closes, maybe even a weekly close. But encouraging action to see big move up here for the IBB this week. So impressive. We'll see if that is a good washout there. Energy was our second best performing sector this week. It was up 4%, a little over 4%. You can see again, very vertical descent here in December, just indiscriminate selling, and we're getting pretty much a V-shape back up, recovering some of the damage. You can see we're still, well below prices traded, just a month or two ago. So there's plenty of technical damage to repair here. It's tough to want to chase this if you're in for the short term. If you're trailing a stop, if you're active, makes sense, but be tough to kind of chase it here for energy. XLY discretionary, this was the number 3, up about 3% this week. This one not as crushed here as, say XLE was that we just looked at. You can see this is already sort of under, retesting some of the levels from October, November of last year. So really, it's trying to get back up and repair this damage a lot quicker. We'll see again, it's tough to really chase this, but good to see, that we're already kind of putting in a 40 or so % retrace, and we're getting back to some making some investors whole in here from late last year. On the downside, we had technology, XLK, which was flat here on the week. It was up just slightly, so a little bit of under underperformance here in technology. You can see it did not take out last week's highs. Semiconductors had some issues here as well. Which is the third worst performing. These kind of go hand in hand at times, but SMH, XLK, and XLU were the three worst performing sectors this week. XLU did, kind of stabilize back up here at a prior important area right around this $52 spot. This has been where we've seen the market kind of overshoot it many times, but try and hang in there. Semiconductors, still didn't get down and totally retest it. We still have a little bit of positive divergence going on here in the MACD, so all is not completely lost on technology and semis this week, but notable that they did underperform. So, and of course, we had the Apple announcement there, which kind of, affected suppliers and went right down the space in general. So that is it. That is what I have for this week. Hopefully this year marks a good one for everyone. If, closing up the books in 2018, if that was a rough year, if that was, anything else, things you want to change, now's the time to do it. New year, new calendar, new P&L. So hopefully we can all get off to a good start here in January. So thanks so much, as always, for tuning in and watching. Every Tuesday and Friday, you can follow us on the Trade Risk blog or subscribe on our YouTube channel. Keeps you up to date with all of the latest that we are publishing. Thanks so much. Have a good weekend and talk to you guys next week.